Have you ever been paralyzed by your indicators?
Welcome everyone to Traders of the World, our new interview show where we bring inspiring stories about the financial market and incredible guests. I am Matheus Massari, and with me I have Flavio Lemos.
Hello world! Good morning, good afternoon, or good evening, wherever you may be around the world. I'm Professor Flavio Lemos, Chairman of the Brazilian local chapter of the CMT Association and author of some investment books. And we're speaking English because we want to show inspire new traders like you around the world. I hope you all like it. Subscribe to our channel.
I'm sure that our conversation with our special guest will be truly insightful. And speaking of our guests, today we have the privilege of hosting Tyler Wood, the Managing Director of the CMT Association. Flavio, do you know him for a while, right?
When he's not immersed in markets, Tyler is hiking the mountains with his family or playing percussion for several bands along the east coast of the United States.
He's also the co-founder of Go No Go Charts, a data visualization tool that simplifies market analysis to remove emotional bias from investment decisions. So please welcome Mr. Tyler Wood.
Hey guys, great to be here. Thanks for having me on the show.
Thanks, Tyler, for joining us today. We really appreciate you taking the time for this interview.
Are you kidding, Flavio? You and I have been friends for so long, I wouldn't miss it for the world.
Thank you again. So, Tyler, let's begin. A fun fact for the audience. You told us at the CMT Symposium in New York about the concept of a word from Ghana called Sankofa. Could you explain that better for us and make a parallel to the life of a trader?
But of course. So we got to see each other in April in New York City at the 50th anniversary symposium of the CMT Association. And one of the great joys that I have working for this nonprofit is that I get to meet some of the founders, some of the innovators, the men and women of Wall Street and Bay Street and Dalal Street who've helped create this discipline of technical analysis and educate the wider financial industry. One of the things that we did this year was we produced a history book on the 50 years of Wall Street and the creation of the CMT Association, Chartered Market Technicians. And so when we started the conference, I went back to some of the things that I learned in undergrad. I had a great ethnomusicology professor from Ghana. I have some family who lives in Ghana. I've been there many times and studied music there. And there's this concept from the Akan people called Sankofa. And it's represented by this Adinkra symbol that we see on screen. Now, you might notice that the bird is moving forward, but craning its neck back around to retrieve that egg from its backside. So the parable or the phrase, Sewo werefina wo Sankofa ayenchi, it really is translated from tree into English to mean that it is not taboo to go back and fetch what you forgot. And so the meaning for all of this to me, and thinking about investors, is that we can pay our tuition to Mr. Market, we can make lots of mistakes in our trading, and they can be very costly. Or we can talk to the folks who have done this through multiple market cycles, like yourself, Professor Lemos, who is teaching folks some of those common pitfalls, some of the mistakes that we all make. And the power of this concept, Sankofa, centers around this, that to know the history and your heritage is to know your current self and the world around you. And that's the only way that we get better and make both a better place for all of us. So that concept kind of summarized for me what that 50th anniversary conference was all about. But also shows like this, Traders of the World are there to help share some of the heritage for where all these tools come from and what was created by the generations before us that could give us some insights into what we can create for the generation to come.
Since 2011, you have presented the tools of technical analysis around the world. So tell us about your beginning as a trader. From the start, what did you study?
So I certainly took a circuitous path into finance, and a lot of the folks in technical analysis that I talk to come from a similar background, which is not strictly finance. They didn't go into accounting. but we studied other things. So I did my undergraduate degree at Macalester College in St. Paul, Minnesota. It was a wonderful 4 years, a great interdisciplinary study. I took classes in political theory, political science, and in anthropology and sociology. I have to tell you that I thought I was going to be a biologist. I really loved biology in high school, and I came to college and realized that that was not the path for me. But I found a different path, and I studied music and liberal arts. And then I joined my now wife in Indiana. She went to a doctoral program, and after auditioning for music school in LA and thinking about just pursuing music out on the West Coast, we decided that we were better off together. So I went to Indiana, and that was where I did my MBA from the Kelley School of Business at Indiana University. And there's nothing against the great professors that I had there, but it was very strictly fundamental analysis, corporate finance, managerial accounting, macro and microeconomics. None of the professors really gave much attention to, or certainly not positive attention, to the field of technical analysis. So it wasn't until 2010 when we moved to New York City, and I found this organization, the Market Technicians Association of New York, MTA was the old name. And I met folks like Phil Roth and Louise Yamada and Ralph Acampora and Bruce Kamick. And they were just so generous with their time to help me understand that what I had learned was how companies work. And if you're going to run a company or be a product line manager or do that, those are very important tools to understand. But if you're going to trade in public markets, you're not buying the whole company. You're buying shares. You're buying stock. And so learning how the market works, that was my next education or re-education, so to speak, through the CMT Association. And that started in 2010. It's been an incredible journey.
As Flavio said in the beginning, how could a trader avoid being paralyzed by a lot of indicators?
I love that question. You guys know me well. And so, I was actually watching the interview you had with John Bollinger, and he brought up this idea of multi-collinearity, or you brought it up actually, Flavio. And the idea behind most technical analysis is that we want to be objective in our approach. We want to remove subjectivity. We want to remove a lot of the narrative or emotional decision-making from our trades. So to do that as a technical analyst, we might look at a number of criteria, a responsible checklist for how we would identify trends. This gentleman, John Henry, is kind of a hero of mine, a great trend following investor, ran the Boston University Endowment, also owns the Boston Red Sox and Roush Fenway Racing. The first time I saw his name was actually when I read the book Moneyball. And the idea there was taking statistics to inform player selection. And they put together championship winning teams for the Boston Red Sox baseball franchise by simply looking at player statistics. So if we apply that to the markets, and John Henry did that quite effectively, first in the commodities business. He started in very humble beginnings in South Illinois on a soybean farm, learned the commodities trade, and then applied this concept of statistical rigor to investing at large. And his whole idea is if you can remove what you think you know or what you believe will be the case and just look at what's actually happening, you can react responsibly. So for all of us trend followers, it might start with simply visualizing whether a security or an index is moving in a general direction from bottom left to upper right. And that's great. Technical analysis started with very classical techniques looking at pattern recognition and price action. But this is still a little subjective, and it's really only useful in hindsight. We can identify that this was a trend once we get up here to the top right corner. Now, if we want to be more objective, we might apply something like Donchian channels, right? Richard Dennis, the famed creator of the Turtle Traders. Flavio, you and I got to spend some time with Jerry Parker at the CMT conference. He's one of the original turtles and now runs Chesapeake Capital. Just a tremendous trend follower. Well, Donchian channels was one of the first rules that Richard Dennis taught them for timing entries. And all they do is they look a look back period, striking new highs and higher lows. And you can be objective about price trending in an upward direction. This Donchian channel is breaking up to the upside. So that's one tool. We have our visual analysis. We have some Donchian channels. Of course, we're going to use moving averages, right? How is price performing relative to its historical average? Well, if one moving average is good, maybe three would be even better. And you start to add additional lines to the chart, right? I talked to some young traders, and they're not even just using three moving averages, they're using many, many more. But you can start to understand that moving average crosses might give you some entry or exit signals. And you can set your parameters around these, the periods of your moving averages, and adjust things to your own time frame. Then you might also look at something like Bollinger Bands, which could be used to identify new trends at the break, at the expansion of volatility from a relatively narrow area. So here Bollinger Bands are tightening, and then we see a break to the upside. Now, what Bollinger taught us was that 2 standard deviations from the mean should encompass about 95% of all the data in a normally distributed data set. We know financial markets are not perfectly normally distributed, but this is significant price action when it's pushing the upper band of the Bollinger Bands to the upside. That's a breakout for a trend follower. Well, then we can add something like volume, a confirmatory indicator. Does the market actually stand behind this new price rally? Are there enthusiastic buyers? And then, of course, we might look at a myriad of different other indicators like the MACD, the moving average convergence divergence, to give us a sense of momentum on those trends. The point of all of this is that this is a pretty small checklist, right? We're looking at 6 different indicators, and we can see that somewhere in this region, there's an identifiable new trend. But where amongst these 2 months of market data do you make your trading decision? Right? When we have enough squiggly lines on the chart, we can convince ourselves of just about anything. And this is a very responsible, pretty simple chart. We've all seen the chaos that abounds on trading desks where people add indicator after indicator after indicator. And the point that I want to make here is that the individual tools, creativity and ingenuity of the men and women who gave us these gifts, that they're so powerful. And we want all of that information. So I'm not saying that Bollinger Bands or moving averages or stochastics or MACD, all of it is useful. But if we could do the computation in the back end and have a chart that is cleaner, that keeps our focus on price, our most important indicator of all, then we have less tendency to introduce those emotional bias to our process. And if you're like me, I'm a very emotional person. If something is working against me, I might be able to convince myself that it hasn't broken all of my rules. In my 15-point checklist, I'm only seeing 14 of those being violated. So maybe I want to hold on to this a little longer, or hesitating to get entry points, right? You're waiting for full confirmation from everything. And that's what led us to the idea of blending all of those tools into a trend following model and having a chart that's very, very simple and elegant to look at.
So Tyler, how did you come up with the idea of creating your own indicator, your go-no-go charts?
We did indeed. So I have a dear friend named Alex Cole, who worked for about 16 years in the product development team at Bloomberg. And he and I co-founded this company called Go-No-Go Charts. And it was that exact idea where one of the difficulties with technical analysis is that you want a diversified set of tools or metrics that you're looking at, but you don't want a cluttered chart. You introduce analysis paralysis, you introduce confusion or subjectivity, you can bring back a lot of the emotions to the table that we were trying to eliminate to begin with. So what we have on screen is a go-no-go trend. And the whole concept was, let's take all those powerful indicators, let's blend them in the background, and then just color code our chart according to that trend following model. So very simply, we have we built some sensitivity in the model. So when we are in a go trend, when you think about NASA launching a shuttle, is it go for launch? That means all the conditions are optimal. Everything in the background, the weight of the evidence is telling us that this security is trending to the upside. When it's in its strong form of the go trend condition, it's in blue. Weak form is in aqua. And then we see in a no-go trend, purple is a strong form downtrend, a no-go if you're a long-only investor. And then the pink is the weak form of that no-go trend. And you might notice here, Flavio, at these points of transition, we also have these amber bars. And that's when all of the criteria in the background are reaching their neutral territory, meaning the market is at a point of indecision. Buyers and sellers are in this tug of war. And so we have a neutral reading in our trend following model. We're both big fans of the life and work of Jesse Livermore. And his famous quote was, in markets, there's a time to go long, a time to go short, and a time to just go fishing. So we have go bars, no go bars, and go fish bars. And that's the real basic go no go trend model.
Nice. That's a really practical system, right?
Yeah, exactly.
As a trader, do you look at fundamentals like account balance or the macro scenario? What else do you look at?
So I think that intermarket analysis is critical. I think that even if you are an equity-only investor, there's so much really powerful information from the commodity space, from interest rates certainly, and then from looking at currency relationships as well. I don't spend a ton of time poring over 10Ks or reading analyst reports on the fundamentals of the company. I do believe in a William O'Neill methodology, which is, he was the inventor of Pan-Slim and multiple criteria that help us understand that there's a fundamental driver for these long-term trends. I believe that markets trend because of strong underlying fundamentals or expanding GDP that gives us these secular bull markets. So I certainly look at the macro factors. I look at influences from interest rates, from currencies, and certainly what's happening in the commodity space, but more as an exercise to understand the general condition and environment that we are in. When it comes to the individual security or the company, I'll be the first person to tell you that as an investor, you can participate in semiconductors. Do I know the first thing about manufacturing semiconductors? Not at all. Do I know what's happening inside the management teams of regional banks in the US? Not at all. And did I do all of that hard work to understand the risk exposure from the bond holdings that those regional banks had at the end of 22 that led to their liquidity crisis in March of 23? No. But as a technical analyst, that stuff shows up on your charts, right? You saw regional banks on a relative chart, relative to the financial sector, relative to the index, crater months before we actually found out that Silly Valley Bank and Signature Bank were collapsing and being, folding under. My point is that, as my co-host on Fill the Gap, David Lundgren, likes to say, the greatest fundamental analyst in the world is the market itself. And so when the story finally comes out, it's usually after the trade has already happened. We know later on why something was the case. And as human beings, we always want to know the why. But if we can have a little faith in our tools and stick with our disciplined process, then we can participate in trends in any kind of market, even without doing all of that fundamental due diligence, because the market is showing us what's happening in real time.
So please, Tyler, could you explain how go-no-go charts works? Do you have any indicators, special things inside or outside? Do you have any other indicators that goes together with the go-no-go colorful chart?
Absolutely.
Give me some examples.
So we talked about trend identification. The next step for most analysts is to start thinking about the concept of momentum, right? And if we want a complete technical view, we should understand the trend condition. We should understand what's happening with momentum. We have to know volume, and then we also want to know volatility. I have cold feet whenever I talk to the great John Bollinger, because he was so creative in innovating these concepts. Volatility was a fixed measure when he first started thinking about Bollinger Bands in the late 1970s. It was inconceivable that volatility could fluctuate for a company. So momentum concepts. We can cruise through this, but we all know, stochastics from George Lane in the 1950s. We understand the idea of confirmation and divergence, of overbought and oversold. We could look at something very simple like the RSI from Wells Wilder in the 1970s, another range-bound indicator that's going to give us, a good reading on momentum. We might even just look at money flow index to get a sense of, a volume-weighted RSI, if you will. And the list goes on and on and on. We can use lots of different momentum indicators to give us different viewpoints on what's happening. Even something as simple rate of change, right? Now, an unbounded indicator like this can go to extremes when you have something like the meme stocks. So your information from these different indicators is going to change based on the environment that you're trading in. And commodity channel index is another great tool that we certainly want to pay attention to. The problem is we can't add all of these panels to our chart, right? This is a go-no-go chart with these 6 simple momentum oscillators. Well, we don't want 6 panels because now price action is almost indistinguishable. So what we did with go-no-go charts was the same idea, blending multiple concepts in the background, and we get a complete chart that looks like this. So we have our trend model at the top. We can understand direction and strength of the security or the asset class or the sector that we're looking at. But then we also have a single oscillator that's going to give us the viewpoint that all of those momentum oscillators do, but in a simplified way. Ours ranges from -6 to +6. So already the overbought and oversold levels are easier to pick out. We also did something a little unique, which is we don't want another histogram on our chart. We incorporated volume right into the oscillator. So where it's dark blue, we have heavy relative volume. Where it's light green, we have light volume. And then the other most important part of this oscillator, if you've read the works of people like Connie Brown and others who have really understood how we could use momentum oscillators in a trending environment, right? Keep in mind, Wells Wilder created RSI in the 1970s. 1970s U.S. equity markets were in a range-bound, choppy mess. So, of course, investors using his tool started thinking, oh, great, it gets to overbought, I'm going to sell because the market is going to mean revert. Well, what if you're not in a range-bound mess? What if you're in a strong trending market? You can still use momentum oscillators to your advantage. In go-no-go charts, what we want to think about is momentum racing off into overbought levels and then coming back to neutral. When we're in an uptrend, as you can see, let's zoom in on this part of the chart. When we are in a go trend, when we're trending upward, momentum is going to surge positive and then come back to neutral and test this objective 0 line, that amber line in the middle. And if it finds support there and surges back in the direction of the underlying trend, that's where, as trend followers, we can really press our bets. And I've got a funny story about momentum oscillators. Ralph came into the CMT office early on when I first started working there. And of course, he's such a wonderful, lovable human being. I wanted to impress him. And so in our library, we had these walls covered with Ralph's hand-drawn charts from his chart room back in the day. And I said, oh, Ralph, right there, RSI is overbought. There's the sell signal. He said, oh, Tyler, sit down, son. Let me teach you a thing about momentum. And Ralph said, here's how I want you to think about momentum. Imagine there's a baseball in your glove. Ralph's from the Bronx. Everything's baseball with these guys. You got a baseball in your glove. When you throw that ball in the air, that's the fastest it's going to move, right? The velocity, the momentum of that ball is fastest the moment it leaves your hand. And then it's going to travel up to the apex, right? The highest point where you've thrown it. And it's going to keep going up, but it's going to go up more slowly, meaning your momentum reading is higher. It's making lower highs, right? It's decelerating. It's exhausted. And it's going to come back. And what do? You catch it in your glove. And the game of catch continues as long as you catch it in your glove. So coming back to go-no-go charts, that 0 line, when we're in a strong go trend, momentum is going to surge positive, but it's going to come back to the 0 line, to neutral. It's not going to go oversold. If it does, that's a direct threat. That's a strong divergence from what we're seeing in the trend behavior. That implies excessive selling or negative momentum for that security. So if we catch the ball, unlike me, Butterfingers over here, if you catch the ball in your glove, the trend can continue and it will surge and come back to neutral. And it's folks like Connie Brown and Andrew Cardwell, excuse me, who have written about how we could think of momentum oscillators in trending securities and trying to define those ranges. But again, with most momentum oscillators, it's a very subjective methodology. So we make an objective zero line, and you can see right on the chart where it comes back to find support, and then the trend continues. So that's more of a complete go, no go chart and a view on momentum, volume, and volatility.
What is your current view about the markets where big techs are outperforming the small caps?
So from an asset allocation perspective, I mean, we pay attention to the Morningstar 9 style boxes. So you have growth versus value, large cap, mid cap, small cap, and the blends therein. Certainly, we have seen large outperforming small in this recent rally, and growth equity sectors, information technology, consumer discretionary, and communications in the U.S. Stock market have been leading. But let's not forget about energy, which is also in the leadership group. And earlier on this year, we saw that rotation into cyclical sectors like industrials, even materials, and financials. Right? Remember those bank collapses we were talking about in March? Financials were leading over the summer. So I keep a very close eye on rotation through the sectors, but we also take a very close look at style allocation as well. And with a lot of our institutional clients, they're wealth managers, and they're running fairly what would be common to the technical community, tactical asset allocation models. They want to make sure that their sector bet is right and that they're overweighting the relative strength leadership. So relative to the S&P 500, you look at those sectors. Within the sectors, you can look to the industry groups. And here's what I'll say about small caps. We had a recent interview with a great technical analyst on Fill the Gap, the CMT podcast. We were looking at the chart of the Russell 2000. Now, there's a lot of resistance at 2000, and we've struggled to get above that price level. But we've had this series of higher lows throughout the last several months. I mean, it's almost a year-long ascending triangle pattern. So I haven't forgotten those lessons from Edwards and McGee about how important it is to see price patterns as an expression of what's going on from investor behavior. So yes, there's a supply, there's resistance at 2000, but we're seeing those series of higher lows, meaning that buyers are stepping in at higher and higher price points on a small cap index like the Russell 2000, where there's more and more demand eating out. And so it's not selling off, it's simply basing out. And I'm very bullish on what seems to be a very constructive setup to this market. It's not surprising to me that here in September, we've seen some of the very largest names roll over, like Apple. But if you look at a weekly chart of Apple, we've simply come back down to what was a resistance line in the end of 2022. It's now support in 2023. That's that polarity principle, a core concept for technical analysts. And so as long as we're above that support line, what was resistance last year is now support. It seems like a pullback within an otherwise larger term secular uptrend. So I don't think the story is over for large cap tech names like Apple. But certainly it makes sense for them to take a pause. And, you know, we're seeing that rotation in terms of leadership into other sectors of the markets. Right now, energy is the leading lady, so to speak. And it's nice to see that that rotation take shape, because we can't have a raging bull market unless there's more participation. We want to see breadth expansion and all of that. So yeah, that's what I would say about large versus small and style groups.
It's healthy for the market. Other companies participate. If there is not just Nvidia at the market, there is another 5,000 names in the market.
You know, you make a great point there, Flavio. In a cap-weighted index like the S&P, some of these extremely large names, if they're not trending upwards, then the index can't really go anywhere. So as investors, we have to know that it's a market of stocks, not a stock market, and start to diversify our holdings and look to individual securities or industry groups so that we are capturing those things that are relative outperformers and not just passive index holders, as many fund managers have become.
Tyler, do you consider yourself a trend follower trader, a swing trader? What's your personal style as a trader? What's your personal trader's routine?
So let me first declare that I might be the world's worst trader. I do not pride myself on my historical track record for trading individual securities. With our family, and given how busy life is, I have a very simple tactical asset allocation model. I use Go-No-Go charts in everything that I do, but I'm just rebalancing weekly based on relative strength leadership. And that's for the equity side of the portfolio. I have some longer term holdings that are maybe more thematic based, and that's largely driven by the intermarket work and some broad themes. So I keep my trading to a minimum. When I did attempt the very short term work, gave me great stress and anxiety, and I made all the behavioral mistakes that everybody makes. So I found that longer time frames, sticking with the trends that are working, and a much more simple asset allocation technique is better for me, and I'm a happier husband.
But buy and hold is a trader strategy, so it's okay, no problem.
Buy and hold. That is what I learned in graduate school, and what I have heard so many fund managers. They pound the table that that's the way to do it. The problem is those once in a lifetime events. They've happened 3 times in the last 20 years. So if you're a portfolio manager and you tell your clients we're a buy and hold strategy, we're just going to get into something and we're never going to let go. Well, 3 times in the last 20 years, those clients have been cut in half. To me, that's malpractice. That's worthy of some disciplinary action from clients to PM. Because what else are they paying you for, if not to take an active approach and protect their downside risk? So those once in a lifetime events seem to be happening a little more frequently than the buy and hold folks would like to admit.
And Tyler, could you tell us more about how to become a CMT charter holder?
Absolutely. So this organization is near and dear to my heart. The CMT program itself is open to anyone that's interested in learning technical analysis and a responsible approach to these tools. I'll tell you, there is a lot of content out there about technical analysis, but when the organization first started in the late 1960s, there was this environment. They called them tip and clip clubs. So predatory broker dealers were trying to give clients this get rich quick schemes, and they were saying that was technical analysis. And in 2020 and 2021, we saw a lot of TikTok traders coming out with very silly schemes. We saw SPACs explode, the cryptocurrency craze, the meme stocks. Everybody was trying to make a quick buck. Well, that's irresponsible. And so the CMT program was set up to differentiate, to create a rigorous standards of competence and ethics in financial markets, and it's for professionals. So anybody can come in and sit for the exams. In fact, we have a very robust academic partner program. There are university students all over the globe who are learning these tools and sitting for the first levels of the exam. But to be a chartered market technician, a CMT charter holder, you do have to have professional work experience and be a contributing member of the financial services industry. It's 3 levels of exam, and this is your level 3 textbook. It's pretty robust. It's about 1,200 pages, and it's a lot of hours of study. Getting through the exam process, what I found, certainly a lot of hard work. But comparing that to some of the other subjects that I've studied in my life, this is so practical. Like, you finish a chapter that night, you've taken some notes, you've got ideas in your head, and the very next day, you can put them into action. You can see it happening right in front of you on your charts, as opposed to some of the accounting classes that I took in college. First of all, you're waiting for quarterly data reported by the companies, and then it's often restated after the fact. You can't always believe what the companies are telling you, circa Enron or you name your financial collapse. But what I have found with the CMT program, besides being so practical, is that it's a real career benefit. So we survey all of our charter holders, and we've looked at what they have gained a year after earning their CMT charter. A lot of them have new positions. They've been recruited away from their current firms, but over 60% reported having increased responsibility, which for a portfolio manager, what that translates to is assets under management. So either the firm is allocating more capital to them, or clients are bringing more money to work in their fund because they believe that that person, having earned the CMT designation, has a defined, repeatable process for managing risk and capturing reward. And I can't encourage people enough. Obviously, I'm biased, but for me, the CMT program, even after being around technicians for years, I found that the breadth of topics covered really opened my eyes to other areas of the market that I wasn't currently incorporating into my discipline, into my practice. And it's a really powerful program. But of course, the learning doesn't stop just with the exams. Our membership around the world engages in continuing education all over the place, like the symposium and our webcasts and journal publishing and magazines and you name it. We produce a lot of content and try to keep everybody on that cutting edge of where the discipline is headed. So more information is at cmtassociation.org.
So, Tyler, besides being a CMT charter holder, what advice would you give to younger traders? Also, could you suggest some good books?
Yes. So I would tell everybody in their youth to make as many mistakes as possible and get really comfortable with it, right? Investing is not about being right. It's about making money. And so the sooner you can grasp the idea that the market is there to make a fool out of as many people as possible, the sooner you can understand that there will be trades where you are wrong and you need to get out, the better you will do long run. And people think that's crazy. When I talk to university students, they're all trying to get the A on their paper. They're all trying to impress the professor, and so they're terrified of failure. And I think that's really dangerous. Think about baseball. When a professional Major League Baseball player bats 300 throughout their career, we put them in the Hall of Fame, and children go around carrying their trading card and wearing their jersey. Well, batting 300 means they strike out 70% of the time.
Wow.
They strike out 70% of the time, and they're the best in the world. And so when you talk to these trend-following investors like David Harding at Winton Capital, or Jerry Parker at Chesapeake, or Paul Tudor Jones, they love their losing trades. They're looking for them all the time. They embrace their losing trades because they want to get out of them as quickly as possible. They admit that they're not always going to be right. And I think the sooner we get comfortable with that, the better off we will be as investors. It's certainly okay to be wrong. It's just not okay to stay wrong. And then you asked about books to read. I certainly think everybody should pick up the CMT Level 1 curriculum, regardless of whether you sit for the exams. It's a great, broad overview of basic terminology, basic concepts. But I've loved the Market Wizards books by Jack Schwager. Those personal stories are just incredible. I would encourage everybody to pick up a book by Andreas Klenau, who's written at length about systematic trend following and CTA industry. And then I would say, Daniel Kahneman's Thinking Fast and Slow. If you want to understand sort of the human psychology component, the behavioral side of investing, that's a great read as well. And for those who are thinking about, sort of asset allocation and all that, Meb Faber is a CMT, and he's written a lot about the Ivy portfolio and global asset allocation, and those are all really great reads as well.
Jack Schwager was here with me in 2004, and he made a great presentation with Steve Diesel too. So I know him personally, and I knew Klenau this year in New York. He has a wonderful trend follower books. Huh? He's the Bible of the training following is his books.
He is a very
So,
prolific author, as are you, Flavio. So I will tell everybody who's watching Traders of the World, if you are Brazilian, you got to pick up a book by Professor Flavio Lemos.
thank you very much. Thank you very much. My kids are pleased for this. Okay, Tyler. In 2022, in Washington, D.C., you told me to get on stage and make a presentation with no preparation at all. And I said, okay, I will do that if you give me a beer on the stage. And it did. And I did the presentation. So now it's my time to end with a grand finale. Could you play some drums for us?
How did I know that that little stunt was going to come back to haunt me? And by the way, you and Eric Conrad, and JC Peretz, and Akshay Chincholkar did an incredible job because with the language of technical analysis, it doesn't require hours and weeks and months of preparation. You can have a sensible commentary on any market worldwide just by looking at the chart, because the tools are the same whether you're looking at a weekly chart of the S&P 500 or a 1 minute chart of GameStop. You can apply the tools in the same way. So, A plus to you, Flavio, for taking the challenge. And I guess it is my turn. I thought maybe instead of banging on my loud drums, you brought up the concept of Sankofa. So Flavio, I spent a lot of time in college working with an ethnomusicologist named Soa Mensah. And Soa is from Ghana, and he taught us lots of different music. This instrument is called the Jil, and it is from northern Ghana, from the Dagara people. They play this welcome song at social events as people are coming together as a way to bring about that festive spirit. So here is the welcome song played on the Jil.
Amazing to see the side of your talent outside of the finance world. We truly appreciate your sharing this part of your life with us. Thank you very much.
I found trading can be very stressful. It can occupy too much of your mind. You have to step away from the chart sometimes and do something where you're concentrating elsewhere. And for me, that's music.
And we come to an end of this incredible interview with Tyler Wood. We want to thank you all, our viewers, for joining us on this journey.
We also want to say thank you very much for Mr. Tyler Woods for sharing his history and outstanding achievements with us. We hope that Tyler's dedication and success serve as an inspiration to many trainers around the world.
Thank
So,
you guys
Tyler,
so much.
your farewell.
We will see you whether in Brazil or New York or Dubai very soon.
So thank you everyone, and we'll see you in the next interview.